Welcome, everybody. We've certainly got a lot to talk about. Trump waited till just a few minutes ago to announce some stuff specifically for our meeting. So
That's thoughtful.
we'll definitely talk about that. We did find out just over the last couple weeks that we need to move back to Zoom because of some compliance limitations. So we're going to be adjusting that in the future. So we're going to have our normal topics: the market, treasuries, the economy. We will touch on the Fed, not so much on alternatives today, and then a separate agenda item before we go to the takeaways. So S&P 500, this of course is from a couple days ago, and if you looked this morning, it was much lower than this. I'm not sure exactly where we are now. As I said, Trump announced something right before our meeting. So he has paused the tariffs for the majority of the countries that he placed the reciprocal tariffs on. The only countries that he did not pause those tariffs are the countries who countered his tariffs, whether it be through currency manipulation or increased tariffs on their end. So we'll touch a little bit more on tariffs, but what we've seen is the market really liked that, and so the stock market is up today significantly. The last I checked, the overall was up 5 to 6%. So that being said, that does not change where I think things are going. So we'll get into that in a minute. So you'll see again the market slide to the left. This is the S&P 500. This is over a 5-year period. And then you'll see a very similar slide next to it that shows what typically happens. We've actually looked at this slide several times in the past, but what initially happens is you have a rise up and then a sell-off, and then you get exuberance, and it goes up to a very high point, a new paradigm, and then you have a correction. And where I think we are now is the return to normal. We just had a big step up today as we had a pause on the tariff conversation. And as far as tariffs go, they are a non-factor in the short term on our economy. They're really being used as a negotiation tool, as you can see by the pause today. But it does not change the fact that the stock market is still extremely overvalued. And ultimately, what Trump is trying to accomplish is to get interest rates down. So we'll talk a little bit about that in the future. But we're at that return to normal stage. We could see it go up more than where it is today. But ultimately, the trend on the stock market, I believe, is going to be down for the next several months. So we're getting a reprieve and an opportunity to clean some of those last few stock positions, or at least reduce some of those stock positions out of our portfolios and be prepared for opportunities as we go lower. So 20-year treasuries, we actually saw the yield spike just over the last day or two. And even though they had been declining significantly, we saw the 10-year treasury get below a yield of 4, which is a significant number, and then has since come back to close to this number. Even though this is the 20-year, it's come back close to this number. And the reason I suspect that that's happening is not necessarily retail investors selling their bonds, which is what would normally cause interest rates to go up like this. But what's happening is the largest holder of treasuries is, number one, reducing their exposure to the US dollar. China actually said to their banks to not take on dollars just this morning, I believe. And then, as the largest holder of US treasuries, China could throw a lot of liquidity into the market, which might be what's happening, which drives up the yield but drops the price of treasuries. And again, what we'll see is on future slides why that's important and why we want those yields to come down and what ultimately that will look like. Right now, what it looks like is we're getting to a point where it might be worth buying treasuries again. So again, we'll get into that a little bit further in a future slide. Go ahead. So I kept this on here. This is actually a copy of the slide we used last month. Stocks tank as Trump declines to dismiss recession risk. Trump, and I said this last month, Trump wants a recession to lower interest rates. And there's a number of reasons. Money is cheaper when interest rates are lower, which allows for faster growth. Also, the US government has 36 trillion in debt. And if you're paying 4% interest on that debt versus 2% interest on that debt, it makes a huge difference in the amount of interest and how fast you can pay down the debt. And so one of his plans is to get that interest rate lower. And it's one of the reasons he's put so much pressure on the Fed to start cutting interest rates. And they're fighting it tooth and nail. But one way to get interest rates to go down is a recession, or even the appearance of a recession, because the stock market starts to come down, as we started to see, and then that creates a flight to safety, which gets bonds to go up in value, which gets their yield to go down. And so ultimately, I want to say we have something like $8 trillion of treasuries that are due to mature this year. And so he wants them refinanced at lower interest rates. So that's what the recession talk is. And keep in mind, this article came out before we had the big 10-15% drop in 2 weeks. So it's all part of the plan. Next. Okay, so last time we looked at the VIX and we talked about how there's a seasonal spike in VIX, and how we were seeing it at 27. This morning I saw it above 50. And the VIX is the volatility index. It's how volatile the stock market is up and down. It's kind of a fear index. And when there's uncertainty, this index rises, and typically there's a drop in the market that correlates with that index. So it doesn't really measure anything other than the fact that there's a lot of volatility built into the market, and That means a lot of people are paying attention when maybe normally they wouldn't be, and specifically the retail investors, the you and I of the world, not the smart money. And what that does is it causes people to sell out their 401ks or any of a number of different things. Um, Referencing back to the chart with the S&P 500, where it shows the significant growth and then the dip and then the growth back up. So the red line represents what typically happens in a market. So we hit that new paradigm at the top. We had a significant dip. We're in that return to normal phase. What often happens here is people go, okay, we had our dip, it's time to buy. And maybe that is true, but ultimately, I think we have a lot further to go down. And so I don't want people to make a snap judgment and start buying. If, for example, you have a stock you want to buy and you want to buy 100 shares, I would consider buying 20, maybe a 20% position at this time. Because I do, again, think we're going much lower over the next 6 months or so. So when you're thinking about it, think about this chart and think about where we likely are in the scenario. We have not gone back down to the mean, the dotted line, which is where historically stocks should be. We're way overvalued. And so things have to come down quite a bit still. So the Fed, they're being stubborn. They probably should be lowering interest rates. The next slide is going to show inflation. And one of the big factors for them not cutting interest rates has been the fear of inflation. Well, the true-flation number is at 2.3%, which is well below the number that they were targeting. And we should see that number continue to shrink as the fear of a recession starts to increase. We should see that inflation number go down. So I would not be surprised if the Fed cuts rates at their next meeting. So gold, we've seen gold continue to rise. So a month ago, we were at 28.91. I think we're above the 3,000 number today. This is from a couple days ago. I think gold and silver continue to be a good hedge. And when the stock market was coming down significantly, gold and silver moved down for a portion of that and then spiked up. I think that's still a good hedge, and we still may see lower prices on gold and silver and see that opportunity to get in. Now, silver versus gold was kind of interesting to look at in that it is actually down over last month. And I believe part of that is the industrial use of silver. Gold isn't really used in industry at all, and silver is. And so the fear of a recession potentially dropped silver a bit in that scenario. That being said, I think that overall trend of upwards will continue going forward. Okay, so we've touched on all of these at least to an extent, but I'm going to do a little deeper dive on each of them. Certainly the big media darling right now is tariffs. It's what everything's being blamed on. It's what's causing the ups and downs in the market. at least in the short term, even though most economists would tell you tariffs are bad in the long run. They do not help the economy. They actually increase the price. They create inflation for citizens of the country that's initiating those tariffs. However, any honest economist would also say they're a very good negotiating tool, something that allows you to shift how things are structured. And I think Trump's announcement today only solidifies how he's using them. He paused for 90 days the tariffs, the reciprocal tariffs on countries who have come to the table in good faith to negotiate. So I don't believe he is looking for a long-term tariff solution. He's looking to even the playing field a little bit. And so his announcement today kind of shows that. Number two, tax cuts. Tariffs in coordination with tax cuts actually will add more money to the average citizen's pocketbook. In fact, what they're hoping to do is be able to reduce the tax rate for any American who is making 150,000 or less a year to zero. And looking at the numbers, just based on tariffs and tax cuts, it would be difficult to make that happen. And be negotiating in the way that they are. But the other thing that tariffs is doing and has done over the last couple months is it's created over 5 trillion in investment in the US, where companies from outside the US and countries from outside the US have moved industries or committed to moving industries and factories and plants into the US, which would create jobs, which would strengthen the economy. All of those things will contribute to creating a economy that's strong and creating tax cuts for middle-class Americans. Number three, deregulation. So I think we've talked about this before. I'm going to use Los Angeles and Pacific Palisades as an example of this. California being one of the worst regulated states or overly regulated states. Of the thousands of homes that were burnt down, only two, that's 2, have received the go-ahead to rebuild. So you have months and months and months of red tape just to get the approval to rebuild. That is not just Los Angeles. That's not just California. That's the federal government as well. You have all these different layers of regulation. And I know we've talked about the Chevron doctrine, which is a Supreme Court decision that was made a year or two ago that actually talks about who makes laws. And Congress makes laws. For any of you who saw the after school bill cartoon when you were a kid, Congress is who makes laws. They're the only ones who make laws. And what the Chevron doctrine says is you can't have a regulatory body that creates its own laws or rules or fines, then manages those fines, and then ultimately receives the benefit from those fines. It only creates more and more and more bureaucracy. The more you're able to do that, the more you do it, and the more money you bring into your bureaucracy. So um, there's a lot of examples of that. If we can eliminate some of that bureaucracy, which is currently going on, if we can, as they say, cut the red tape, you're going to see growth in a lot of different areas, and you'll see an improvement in the economy just based on that. Number 4, reduction of wasteful spending. So without getting too far into the specifics, government is not efficient. I I saw this question the other day. Name one area where government has done something that improves your life and does it in a cost-effective way that couldn't be done by a corporation in a much more efficient way. And I really struggled to think of something that actually fit that description. That being said, there are certain safety nets that do exist and need to exist, but also need to be restructured. So, for example, just in the last couple days, we found out that many of the illegal aliens were actually issued Social Security numbers through email and have since been able to apply for Medicare and Social Security benefits based on those Social Security numbers, um, which legally they should not be able to qualify for. Also, we found out that thousands of individuals over the age of 120 were receiving Social Security benefits. I don't know anybody over 120. Maybe some of you guys do, but I certainly can't think of thousands of people over 120. And that's billions of dollars that's going out each year. So I do not think Social Security is broken in the way that we've been told for years, where it's going to run out of money. I believe it just needs to be managed efficiently. I think we need to make sure we know who is of age, who's alive, and make sure those things are managed properly. Social Security, Medicare, they're not going anywhere. They're just working on getting those to be managed much more efficiently. Number 5. So we talked about this a little bit already, but interest rates are one of the most crucial things um, for making this entire plan work. Making sure interest rates come down so middle class individuals, millennials, all these folks that are just coming up in the world can afford to buy a house, can afford to live where they want to live. Um, if interest rates come down to a reasonable level, that makes every bit of this not only possible, but almost inevitable. So there's two ways that rates come down. There's market pressures on rates, which is people buying treasuries, which drives up the price, which reduces the yield, which means you can refinance those bonds at lower rates. And then there's Fed policy, where they can go in and reduce the rates. Both of them are important. The market can drive the Fed, however. The Fed has very little effect on the market in that same vein. Meaning, if people are buying bonds for safety to avoid riding the stock market down, that interest rate is going to go down no matter what the Fed does. But the Fed can raise rates or reduce rates, and it may have a short-term effect, but then the market still decides where those rates go. So they're both important, but ultimately, all five of these things are working in our favor right now. And the announcement just recently by Trump just kind of should put a few people's minds at ease about the tariff discussion. Clearly, he's using them as a negotiating tool. Okay, that's all I have. Biggest takeaways are the market is likely coming down much further. Interest rates are likely coming down. I do see manipulation potentially from China in those yields right now, which could be a huge opportunity for us, as we've talked about for a couple months now, a few months now. We could see those treasuries come down in value to a place where we want to buy significantly. But ultimately, everything we've been talking about for the last at least 12 months is happening as we speak. Things are going the way we expect them to go. Okay, questions?
Given that we're waiting for prices to drop, both on treasuries and stocks, does it make sense at this point to take our dividends into the cash account, and rather than repurchase?
Yes, in fact, probably 95% of you, that's what's happening currently.
Okay, thank you.
Yeah. So I absolutely, I think it's not a bad idea to set aside the dividends and interest you're receiving and have that go into the money market, looking for those opportunities. And again, 95% of you on here, that's what's occurring. Some of you have specific positions that the dividends are compounding right now, but for the most part, it's going to the money market.
Basically, if the strategy at the executive level is to kind of drive the economy into a ditch, is that a strategy that's ever been done before? Has it ever worked before?
Yeah, so I wouldn't exactly frame it that way, because there's countermeasures. So, for example, yes, we want to cause a bit of a recession. I would argue, if you look at the true numbers, we're already in a recession. It was artificially managed by a lot of federal government jobs added over the last couple of years. I want to say something like 2 million, which just adds to the inefficiency that we're trying to counteract. But in kind of to address more directly what you're saying, yes, we want to create a recession to force the Fed's hands to lower interest rates, to get assets at lower prices, where, including homes, at lower prices where the middle class can afford them, and at rates that they can afford them at. But at the same time, cutting tax rates, which should have the net result of more after-tax dollars for the average American, even in a recessionary period. And then, given that and the cuts in interest rates and the availability to more money, cheaper money, that should increase hiring, and all these trillions of dollars of investment coming from outside corporations and outside countries already committed. We should see jobs go up. We should see the average income go up, and not just dollar for dollar, but in real wages. So I think it's going to be a very short-lived trip into the ditch, as you said, because there are all those other countermeasures that we talked about that are coming into play at the same time.
But has this ever been done before? I'm trying to think of any kind of historic precedent.
So that's a great point. Never have we had a president focus on all 5 areas at once. And in fact, I'm writing a blog post right now that talks about this. So thank you for that. It talks about how historically you look at a president, they may focus on inflation. So Biden, his big thing was to reduce inflation. Obama's was recovery from the Great Recession. And so you have these single faceted approaches to the economy. Meanwhile, they're doing a little bit of everything in the background. This administration is working on all of those things at once. So in that way, no, I don't think it's ever been done in similar fashion. Again, I wouldn't characterize it as driving the economy into the ditch, but certainly working on all of those things at once has not happened before. And I think all of this will look much better by this time next year. I think we will see a bottom in the stock market. I think we will see bonds increase in value significantly along the same timeline we've talked about for months. In fact, the long-term treasuries were up significantly a week ago, and then they've come back down just in the last few days. So I think we're right on the path to everything we've talked about. And I think the economy will be booming 12 months from now. Any other questions? So the last thing I would say is, in relation to that red line chart that we looked at, if you have money that you're concerned about in the stock market, I would look at today and potentially the next few days to a week as a good opportunity to cut your stock positions a bit more. You're going to get that bounce that allows you to clean house a little bit, especially if you're right on the line of retirement, meaning 3 years before or 3 years after. You really want to protect those assets.
I have a question kind of related to that.
Sure.
If the spike holds today and we get another 2 or 3 days out of it, maybe, would this be a good time to pull out some of the RMDs rather than waiting to see what happens for the rest of the year?
Potentially. I guess it depends. So what a lot of people do is they take their RMDs and then they roll them into a taxable account and reinvest them. So if that's the scenario, it's probably not, it's neither here nor there. If it's money that you are going to take and use for something, then probably it's a good time to do that. Certainly, if you have concerns or agenda items I did not address today, reach out and we'll schedule a time to chat. Thank you.